Hello, everyone. Welcome again to another EU Made Simple live stream. I'm here with Lambertus, our host and CEO, and myself, of course, the co-host and manager of the French channel. It's great to have you here. And today, we're here to talk about the economy, which is a topic everyone cares a lot about everywhere in Europe, really. And I'm just going to start off with Lambertus. What's your thought about the economy in this moment? I mean, the thumbnail is very drastic, but how do you feel?
Yeah, you made that thumbnail for sure, didn't you, Paul? But yeah, no, you're not wrong, right? I mean, it depends what we're talking about, which countries in the European Union, because some are doing better than others. And I always have quite a German perspective, not because I'm German, but because I live in Germany. And the GDP growth forecast for this year has been cut down from 1%, which is already diabolical, down to 0.5%. So that's for an industrial nation like Germany, where there's a lot of cost, there's a social state that's growing, etc. Having no growth is really, really bad. And yeah, the economy is fucked because without this growth, there's just problems, right? How are we going to pay for the defense? How are we going to pay for demographics that is aging, right? We have an aging population, meaning there's less people in the workforce. And the economy doesn't look like it's about to get better. Multiple reasons. I'm sure we're going to get into it. Just to give you some examples, the Strait of Hormuz is a big one now, the war with Iran. And of course, also tariffs with the US. I mean, I'm sure we're going to get into it, but Trump now saying 25% tariffs on cars. Man, Germany just can't catch a break, man. They can't catch a break. So from a German perspective, it's not looking good. How about you, Paul? You're French. How is it looking like in France?
Well, over here, it's not much better, Lambertus. I mean, you talk a lot about Germany, and all the problems we have in Germany, we have them in France too, but we have the added problem of this massive debt burden. We reached, the numbers just came out last weekend, we reached 117% debt to GDP ratio, which is absolutely insane. Yeah, thank you very much. And it gets crazier when you look at the interest rates. And I mean, and that's kind of where I want to take this. So this is going to be more of a liberal flow of just talking about how the economy is doing in general. But I do want to structure it a little bit. And today, when you look at the economy, everyone thinks about Hormuz. I mean, you just mentioned it. It's the massive one, right? Oil prices are skyrocketing. And just because of one man, Donald Trump. And actually, as we were starting this live stream, someone in the chat told us that the UAE just got attacked. So for all those who believed in the ceasefire leading to a peace deal, that's not looking very good. But what I don't see much talked about is, a lot of Americans talk about the American economy, how that's going to be affected. But what's not talked about as much is the European economy. We see, okay, sure, jets will be canceled, during the summer, which is obviously never a good thing. But it's more deep than that. It's deeper than that, right? I mean, with the oil prices, if you've seen our videos, I mean, Lambertus, you made these videos, you have a high inflation coupled with a recession. I mean, this is what Germany is going through. As you just said, Germany's forecast growth going down has been cut in expectation. I just wanted to ask you, Lambertus, is Germany accounting for this long-term strategically? You're talking about Merz this morning. I mean, what's the plan there?
Yeah, I mean, I think also just a quick explainer, what many people, I had this conversation with my girlfriend actually the other day, is what she didn't realize. She's like, oh, well, people will just have to fly less and drive a bit less with cars, and then that's that. But obviously, there's a whole bigger picture here, because if petrol's more expensive, the goods that are brought to your supermarket will get more expensive because it's more expensive to transport those goods, right? And that goes for the entire supply chain. So pretty much everything gets more expensive. So just to really bring the point home that that not having enough oil in Europe affects everyone, not just if you're driving your car. And the way in Germany, no, they're not really accounting for it, right? I mean, they're already having so many internal issues here in Germany about other things, and now this just came on top. And there is no answer. Let's be honest, there's really no answer. It's just more about the hope that this crisis will blow over, I guess, at some point. I mean, there are some government measures. I'm not sure about France, but in Germany, for example, the measures that have been put in place we're decreasing petrol prices, taxes by 17 cents. And what we're also doing is we're giving like an optional bonus for companies to pay tax-free to their employees of 1,000 euros. And that's it. I mean, that's not going to change the economy. That's not going to make things better.
But also, Letoxland says, and this was a very good point in the comments, said that the GDP before the 2008 crisis, we were growing faster. And until there was a financial crisis where we brought to a stop. And that I say, yes, 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 because it's basically been since the 2008 financial crisis that Europe has been in this zombie mode with some of its companies. And that's something I want to touch upon later in the video, that Europe has just not adapted in the same way, both in the financial sector and everywhere else in the economy. I mean, I was thinking about this when it came to the BMW, who was laughing at Elon Musk because Elon Musk wanted to make electric vehicles. And, 10 or 15 years later, we're not laughing so hard now, right? So some of the things, lack of innovation in Europe.
But I think also, I mean, again, if we're talking about Germany here, right? Germany had such success in the 2010s of exporting their cars worldwide. They were growing, they were rich, and almost they were getting too fat, almost, if you know what I mean, too comfortable in their success. I think that's the right way to put it. And it also resulted BMW making statements like that. Not BMW, I think it was Volkswagen actually, Paul, that said it. There was like a C-suite manager there that was laughing at Elon Musk's electric cars. I mean, who's laughing now, right? And it's not just the car industry and the C-suite there. It's also the whole political layer, right? I mean, Merkel was very, very good at keeping the ship moving, right? But you could argue that she was not very good at actually implementing reforms and changes that Germany would have needed today. Right. So I think if Germany was, there's lots of reasons, but that's another reason. It was so successful that it just got lazy. Lazy is the wrong word, but too comfortable. I think that's the better word.
I like your ship analogy of Merkel keeping the ship moving, and I almost want to say in the wrong way, right? Because we weren't able to adapt, create a European economy and a better way of doing things. And that's actually part of what happened post 2008, right? Before 2008, you had very high interest rates, and I'm going to get into a bit of some financial technicalities here. But you had very high interest rates that were decreased after 2008 to try and stimulate the economy. And these interest rates, all they did was
explain a little bit about these interest rates, because this is where you normally lose me a little bit. So after 2008, you said interest rates were decreased, or what?
Yeah. So just for those of you who are following finance, for example, you would have, say, government borrowing, right? The government, when it borrows money, it borrows from the citizens, from businesses, from governments, other governments in the world, and it does so for certain interest rates. That interest rate is set by the market. So when things are going well, people will have confidence in you, inflation is low, the value of money is not decreasing, then usually you will have a lower interest rate. And that is usually good for growth, because if you have a lower interest rate, it's easier to borrow money, right? Imagine if interest rate is lower, you can buy a car, you can buy a house, and it just costs a lot less money because you have to pay less interest on your loan. But when there was 2008, 2009, and there was the Greek financial default, what ended up happening is this became very risky for investors. So the government decreased interest rates lower and lower and lower, and economic activity basically slowed down. So you had interest rates that were slowing down post 2008 to try and restart the European economies, restart economies everywhere. France printed a ton of money. We borrowed a ton of money. America printed a ton of money. And there's going to be some graphs that will explain that in a second. But the basic effect had that, debt ballooned, and some countries were not able to adapt. So yeah, if actually you go a few slides later, maybe one more, Lambertus, maybe one more. No, maybe too far. Sorry, go back. I'm gonna keep monologuing.
No, Paul. Which one? Which one? Just say what you need.
Go one before. This is Brent's crude one. I mean, this one's actually quite interesting. If you go to this one here, you can see the arrows on the right. When you have interest rates cut, this is the red arrow on the right. You have higher economic growth and faster inflation, and that's what Europe was trying to do, but unsuccessfully, with many of these companies not being productive. And that's part of the problem. Is now interest rates have gone up because of the oil price, because of the oil spike, because of COVID, because of the war in Ukraine. Well, Russia's invasion of Ukraine. And so we're now stuck between a rock and a hard place, where on one side we have super high debt, which we have to refinance at a higher rate. And on the other side, we have a inflation that's coming from higher oil prices. As you can see here, the chart on the left, oil prices going to 110, probably even higher. So it's kind of a mess, and it's kind of the core of what's wrong with Europe today.
So Paul, are you saying, I mean, there's a lot, you just covered a lot of things. So are you saying that you have a bit of a financial background? So are you saying that we're moving towards a European recession? Is that what you're kind of aiming here? Because it seems like a perfect storm, right? We have high oil prices, we have high inflation, we have high debt, and we have interest rates rising, which does look pretty bad.
I mean, it's exactly that. It's a perfect storm. And it's not just a recession, it's a mixture of a recession and inflation. Because inflation from higher oil prices, if you think about it, right? Here you can see oil price using about 70. If it goes up to 100, talking about Germany, the price of creating things will go up, right? The price of transporting these goods will also go up. But Germany will become less competitive because its goods will become more expensive. So all of these things together means Germany will sell, or Germany or any European country will sell less goods, but will have a higher price to make them. So it'll have to pay its employees more, and the cost of goods will just go up all around Europe. So we have this double whammy of inflation and recession hitting us at the same time, not just because of the Iran situation, but a more general effect from the long term since 2008.
But Paul, I would argue against you and say it's not just happening in Europe. Because if we look at the US, especially what you showed before here, inflation, if I read this correctly, is higher at the moment, or at least the start of 2026 in the US than in Europe. Is that a correct reading or not?
Yeah, that's a correct reading, and actually, they're in a lot of trouble too. And I'm kind of thinking some of these numbers are not too correct. But to give you an overview of what economic policy is, usually we target around 2% inflation, which so far the ECB, the European Central Bank, has done a fairly decent job at doing. But Americans have not been doing that. And so what America has been doing is they've been printing a lot of money. They've been printing a lot of money to avoid a recession, because of the tariffs, right? This is creating a lot of issues there. But they're also printing a lot of money to get out of their massive debt bubble. If you think France is in debt, then look at America, right? 35 trillion in debt. It's absolutely massive. And so America has been printing money to get out of its debt issue. But that affects everyone. That affects Europe too. So Europe is in kind of the same boat. And so if you've got American dollar that's decreasing in price, its goods becoming more competitive, and Europeans maybe not doing the same thing, you're going to end up with quite a bit of a mess on your hands.
So, Paul, I mean, I'm just basing on what you just said. So, for example, France is known in Europe to be one of the worst countries when it comes to the amount of debt in comparison to its GDP. And you can see it here for a 113%, right? And the US is at 124. So while is the US in even a worse shape than France is, for example? Because they have a higher bill, right, to pay back their debt.
Yes and no. I would argue that yes, they are, but some would argue no, and I'll explain both sides. Just before we get to that, though, we have a super chat that we just missed in terms of timing from Clotte 3241 with 11 euros. Thank you very much. Who says Europe must end energy imports and think long term. True independence requires bold planning now, yet Germany still makes strategic choices that risk prolonging reliance instead of securing its future. Any thoughts on that?
Man, I could go on about this for literally half an hour, but there's been so many mistakes, right? Yeah. Firstly, I mean, very quickly, turning off the nuclear energy, which Merkel concluded or initiated or partially initiated when she was in power, right? I mean, I think Germany had over 30 reactors, quite a lot, which is kind of critical for a country that creates so much industrial output and needs low energy prices. So that was mistake number one. Merkel then put all the eggs in one basket and worked on Nord Stream 2, right? So Nord Stream 1 and Nord Stream 2 from Russia to get cheap Russian gas. Even after Crimea, that was still a good option according to the German government. And now obviously that fell away, right? So but Germany first cut off its nuclear energy, then it relied on Russia, and that didn't work out. And now they're making another mistake of relying on liquefied gas from the US, right? So this is something I really don't understand about German politics. It's why Germany doesn't put like a lot more effort in becoming independent there. I know there are things they're doing, renewables, for example, they're really pushing wind and things like that. But really, we need to diversify further. And I mean, this might be controversial to some people, but I think the nuclear, if we can somehow turn back this nuclear trend, I think we should do that. And anyway, I'm going off tangent here, but I think this has been one of the biggest mistakes Germany has made in the last 10, 15 years is their energy policy. It's just crazy. And as a Frenchman, I bet you're like hitting yourself like, how stupid be. I knew it.
Yeah. No,
I knew it.
everyone knows in France that we all blame Germany for high energy prices now. Maybe it's not a good thing, but we say now we're selling to the Germans. It's their fault. It's not good for EU cohesion. I'm not gonna lie.
It's just so stupid. I really don't get it. And now literally like liquefied gas from the US is the new thing. It's just, I would love to see the stats on that, but that's not part of this this live stream.
Just a quick tangent. So have you seen Spain is closing its nuclear power plants?
Why are they doing that?
It's the government green policy.
What is this hate against nuclear energy? I would love it. If there's anyone in the comments from the Green Party or that really has a hate against it, I would love to hear, because if people say things again like Fukushima, right, in Japan, where the nuclear plant had a big crisis, I kind of get it there because they have earthquakes, but we don't have that issue in Germany. And if the Germans are good in one thing, Paul, it is quality control, making sure things work top notch. I mean, look at their cars. This is one thing I really do love about Germany, is like what they do create, the houses they built, everything the Germans do, it takes for flipping ever. But when they finished it, it is quality and it's top notch. And the same thing with their nuclear power plants. And that's why I could go on about this for hours. I think it's one of the stupidest things they've ever done.
Yes, I mean,
nuclear waste. Sorry, Paul, you go ahead. Go ahead.
No, I'm absolutely. I agree with you. I mean, but I'm not the most unbiased person there is. So maybe I'm not the best person to talk about nuclear waste. But I would like to say my brother works in nuclear physics, and he has the same talking points as you, Lambertus. So I feel confident in my love for nuclear power.
Right.
But there is another chat that we just missed as well that is in French. £5. Thank you very much, Wako-san, who says in French, France has a lot of experience with nuclear energy. Do you think they can help the EU transition earlier than usual? And I think yes, they can. We can export our know-how. And I'm not just talking about nuclear power plants. I'm talking about something else, maybe nuclear weaponry, right? I think we can export our knowledge, and we can really work with Europeans and the industrial might of Germany to make this very cheap, and we could have cheaper energy than the rest of the world. Imagine there's an oil shock right now. I'm talking about the double whammy of a recession. I'm talking the double whammy of a recession and inflation on the other side. You would not have the inflation from energy shocks if we had nuclear power. And this is becoming into a nuclear power rent, but this could be energy, solar or wind. If we had our own domestic energy production, we would not have any of these shocks. We would not be in trouble right now.
And one last comment about nuclear energy before we go back to the actual topics of the video. But one last comment too. It wasn't about creating new plants in Germany. They already had the plants. It was actively closing them down, even though they could stay operational for like another decade.
And reactivating the coal, right?
Yeah, exactly. Reactivating the coal. And then if we're talking about waste and we're talking about climate change, trust me, coal energy is not clean, right? So that's not good either. So I just do not understand it. And even when Ukraine got invaded by Russia, there were 3 plants in Germany still on, and the government back then, Scholz, with the Greens in power, still decided to close those down, which I don't know. It's beyond me. But anyway, Paul, should we go back to back to your the topic of your European economy?
My rant. So we have this problem, right? Let me paint the picture. We have the problem. We have the double whammy: inflation coming in from high energy prices and stagnation coming from uncompetitive markets, right? That's kind of the double whammy you see here. You can see in this graph from the inflation, you can see what happened when Russia invaded Ukraine and essentially shut down a massive portion of oil and gas exports to Europe. So that's what we're looking at. If this continues, that's the barrel we're looking down. If America continues, which it probably will, to blockade the Strait of Hormuz or at least fight Iran.
Right, but currently, according to this graph, the Europe inflation is at 2.6% and US at 3.3%. It probably will be higher now, but that was the first quarter of 2026.
Yeah, exactly. So it takes a while for the inflation to kick in, right? So because if you think about how markets work, you're going to have the oil come in at a higher price, and then only after a few months will companies increase their prices because of the oil increase, kind of like tariffs with America, right? At first, we didn't see the effects from the tariffs, but slowly the tariff effect is coming in. But it'll take a while for it to affect Europe more globally.
But then again, don't you think we're moving towards a global recession? Because the Strait of Hormuz, yes, it hurts us Europeans, it hurts the US. But what I read the other day is that some of the biggest beneficiaries of that oil through the strait is Asia.
Yeah.
right? So, I mean, surely their inflation figures and their economies will be massively hit too. So I know Europe will get hurt, but is this a global event that we're moving towards?
It's absolutely a global event, but it's and I want to argue it's worse for Europe. Well, of course, I want to argue that because I'm focused on Europe, but it's worse for Europe because of the debt doom loop. This is because of French public debt that is super, super high, and at the same time, the German economy, which is stagnating. So actually, if you go to the slide just before, it's the one with the GDP, exactly this one here, you can see what's happening here. You've got a few countries like Ireland with 12% GDP growth, which is absolutely insane.
It's insane.
It's absolutely crazy, but there's a reason for that. It's trickery. These numbers are arguably a bit fudged. But when you look at the rest, right, you look at France with under 1% growth, Germany with 0.2% growth, right? That was in 2024. Austria, Italy, all underneath 1% growth. This is pre-Iran war. And we're heading towards, now our goods becoming less competitive and massive inflation. And I don't want to be all doom and gloom. I do have a solution at the end of the videos for those of you who are here, man. And Loan, I saw your counter, your Eurobonds counter, but Eurobonds are coming, right? So that will be there at the end of the stream. But we're facing a massive crisis.
But I mean, we do have to briefly talk about Ireland here, right? Because according to this, it's over 12%, and I know last year again it's insane numbers, and this year looking similar. Is that because of the whole tech bubble in Ireland? That this is so insane, or do you know, Paul, why this is so high? I think it is the tech, no?
It's exactly that. It's the tech. American tech industry has moved to Ireland due to their low corporate tax rates, and this has essentially ballooned GDP. If you look, because of the formula of how GDP is calculated, it gives an unfair advantage and a bias for Ireland. But if you speak to those that are Irish in the country, of course, it's been getting better, but it's definitely not been a 12% boom, right? You've got super expensive housing. You have its own set of economic challenges. So
yeah,
it's a slightly misleading figure, even though it's quite good for Ireland.
I mean, it's a misleading figure for everywhere, really, right? I mean, just because the GDP is higher doesn't mean that people are better off.
Absolutely.
I always think it's quite interesting seeing Poland, though. I mean, for me, that's like one beacon of hope that we kind of have in the European Union, right? They've been consistently growing. And I think I saw a Instagram post, so take it with a, take it, I'm not sure if it's correct, put it that way, but it said that GDP per capita in Poland is getting close to GDP per capita in the UK. Which I think is crazy if Poland then overtakes the UK. And please, in the chat, check these numbers. But that's what I saw this morning. I think that the UK, or that Poland per capita could overtake the UK soon, which is insane, no?
It's absolutely crazy. I mean, honestly, Poland is doing everything correctly. They've got an easy market to get access to if you're a worker. English is easy to speak there, so you can emigrate there and work. They're quite open to business and to financial institutions. A lot of financial institutions go there to get a lot of back office work done. And it's growing massively. I mean, as you said, these are real improvements, 3.5% in Poland or 3.6. This is real growth. I talk to Polish people all the time, and it's booming up over there.
I would love to see their tech structure too. Just, I mean, again, one of the reasons I think, and this is my personal opinion of why Germany is also hurting, is their tax law, man. Like, I mean, now I run EU Made Simple for like a year now as a GmbH, like a proper company, and just the taxes and the fees and the amount of admin I need to do, just, I think it's 4 to 5 hours a week on average that I spend not on EU Made Simple, but rather on keeping the business running in Germany and making sure that I am, aligned with the Finanzamt, which is the financial sector here in Germany, who has 300,000 employees, which is also just insane. So I really, really think that the German government here needs to think about how to keep the companies at home, man, because I think a lot of companies are inclined to go to other EU member states, maybe Poland. And I know some in Austria, that quite a few companies in Bavaria go to Austria. Anyway, I'm going off on a tangent again, but I think that's also one of the reasons why Germany's hurting.
But that's a really good example of what's going wrong, especially for these Western economies. If you look at France, now the precise number I'm not sure, but 55% of our GDP comes from public spending. So that means the government is responsible for 55% of our GDP. So what happens here, right? What happens here? When French debt goes up, when we spend more money, firstly, it costs more to reimburse it because people are less confident, or investors are less confident we're actually going to pay back our debts. So borrowing becomes more and more expensive. that money is spent on our massive social programs, which actually it's the same for Germany, even though it has a debt ceiling. Same exact story. And then that money is not used to create new investments and new returns, which slows the whole thing down and squeezes out the actual private markets, which leave the country, of course. And that's kind of one of the main issues with at least the Western countries. You just outlined it with Germany, but it's the same in France. And it's the same, if there's Italians in the chat, maybe you can talk about that too. But I think it's the same in Italy and many Western countries. That's just the problem at the moment.
I mean, here also, I think the EU, this is never going to happen, but it's wishful thinking. But the EU needs to think about like aligning some of the tax laws, man. Because, for example, I know capital gains, I think it's 0% in Belgium. I think so. I think in Czech Republic, for example, that tax, I think, is also at 0%. Oh my God. I mean, like, seriously, correct me if I'm wrong. But anyway, what I'm trying to say is these rates are different in different European countries, different EU countries. And that really encourages people to move, which is fair enough. There should be competition between the countries, right? But yeah, I mean, that should also wake up the bigger countries like Germany. Like, look, man, if people can so easily move from Germany to, let's say, Czech Republic or Austria, you need to make a competitive tax law, you know? Yeah.
Of course,
so yeah. So yeah, anyway, it's interesting.
It's really critical, and it would lead to a lot of benefits. I mean, if you have a unified tax law, you could start thinking about, I mean, firstly, unified tax law would be easier, but you'd have a unified budget, maybe eventually, making the EU its own set of money, which could then be used to issue, for example, Eurobonds. That could be one of the things, the implications that could come from that. So you could reduce some of these national taxes and make them European, and then you would kind of two birds, one stone kind of problem.
Yeah. But the only thing is, sorry, I'm going back to my point before, because if you start standardizing taxes across the EU, you're also removing a competition element, right? Because if all of a sudden all capital gains in Europe is what, let's say 15%, boom, throughout the continent, then that's great. But then if other countries outside of the EU, of course, start offering lower rates than the 15%, then you have people leaving the EU, right? So maybe it is good that there's competition between the member states so that people at least move within the EU rather than leaving it. I don't know. We need to be careful that we do stay competitive, right? Yeah.
It's a good point. But to that, I would argue that, America, there's definitely capital gains tax there. I mean, actually, I hope that there are. I'm not sure about exactly the tax laws there. But, people go to America to invest. I think what we should be prioritizing instead is creating a good market to invest in so that people want to put their money. And then the tax laws and the things that come across there, they need to be reasonable for investors. Of course, if you have 40% capital gains or something crazy, then nobody's going to come to Europe. But if you have a reasonable number, then it could work well.
Netherlands has now created a law that I think it's 37% of capital gains tax on unrealized gains.
Yeah, that's crazy.
It's crazy. So for people that don't know, normally the way it works is if you own a stock and the stock goes up, let's say 20%, you're not taxed on that increase in 20% until you sell, right? Now, and that's called realized gains. So when you realize your gains, then that money is taxed. Now in Holland, what they've done is they're saying, well, we should also tax unrealized gains for different reasons. Some of them I can understand. And that means that when your stock goes up by 20%, at the end of the year, you pay 37. I think it's 37% on that unrealized gain, which is insane, man. Like, who is going to invest in the Netherlands, man?
Yeah, that's not going to end well, especially with their hedge funds. I think hedge funds got an exception, but it's absolutely crazy. We don't want to miss this super chat from Clote 3241. Thank you very much again for 11 euros. Who says Spain and France have only about 2% energy integration, a key bottleneck. Spain produces a large surplus each year with stronger grids and storage. It doesn't need nuclear for its future energy system.
Yeah, it's so right. And I actually talked to a European Union commissioner. I think his name was Dan Jurgensen. He's Danish, I think. Oh, I can't remember. But anyway, he's responsible for energy across the European Union. Or part of his portfolio is energy. And we talked about exactly that, then that he would like to focus on something called like energy highways so that we have a clearer, better grid across Europe so that we can share energy surpluses where needed. So Clo to 3241, you're completely right. And this is something the EU really needs to speed up on because that's such a shame that our surpluses aren't used properly.
Yeah, I mean, absolutely. But this gets me on to back to the narrative, right? Of we have this massive recession coming in and this inflation that's happening at the same time. France is in massive amount of debt, and I just want you to maybe skip a few slides ahead to the debt doom loop, Lambertus here.
Yeah, explain it.
This is basically what's happening to France at the moment. The government borrows money, interest is paid every year, which makes up a certain amount of the budget, right? So the budget is the army, social spending, etc. Some of the budget goes to paying back what you owe, but you can't pay back everything if you're in a deficit. France is in a deficit, 4 to 5%. So it loses money every single year. What does it do to make up for that deficit? It borrows more money, but at a higher interest rate. Before, we would borrow money, as I was saying, between 2008 and COVID, 2020, interest rates were going lower and lower and lower and lower, right? So you could borrow more money and know you'd have to repay less. Imagine before you had to pay 10% on 100 euros, you have to pay 10 euros every year. But now for 100 euros, you only have to pay 1 euro every year. So obviously you can borrow more money, right? And that's what France has been doing. And not just France, Italy too, Germany, a bit less. Of course, with the debt ceiling, it's a much different situation. But now we have this kind of powder keg, which is the French economy, which has 117% debt to GDP and is going to have to refinance its expiring debt at a much higher rate.
Yeah.
This is happening at the same time as a recession, which is going to bring down interest rates, and a German recession as well. So if you see here this debt doom loop, it doesn't look very good. That's because you just end up borrowing more and more money. And the ECB, the European Central Bank, is not able to print properly. It's not able to issue its own debt, which is catastrophic.
Yeah, so basically, just to summarize what you said, government borrows money, the French government, they pay interest on it, but the more debt they have, the more they need to pay, which means the investors lose confidence, which means that the interest rates rise, which means they have to pay even more to service their debt. And then they need to basically borrow more. Oh my God, they need to borrow more to finance that debt. So yeah, this could really spiral down super, super quickly into an unmanageable situation, right?
Exactly. I mean, this is, I've got a chat here saying that this is BS, that there's no spiraling of the debt. Let me tell you, I've worked in finance. People trade this, right? Traders make a lot of money from this practice. This is not an abstract concept in economic books. These are financial decisions made by traders that they make a profit of this. So this is absolutely real. And the problem with this debt spiral is because France is not able to print its own money. There's only one body that can print its own money, is the ECB, right?
The European Central Bank, right? Yeah.
Yes, the European Central Bank. And what that essentially means is when you have the euro, which can only be bought by German bonds, BTPs in Italy, which are bonds, basically, French OATs. These are all bonds that, again, the government issues to borrow money and give an investors a return, right? In Germany, it might be 3%. In France, it might be 4%. So there's different rates. Eurobonds would unify all of that and make sure you have your own interest rates based on the whole euro area at a much lower rate, since it'd be much more unified. And that's kind of why it's so important to try and prevent this debt doom loop, issue European bonds and make sure that there's no catastrophic spiraling, and invest into larger projects.
Okay, but Paul, explain this, okay, right? Because for me, as an outsider, this kind of feels like, oh, okay, look, we are such a problem or trouble in France and other European countries with debt, so we can't really borrow more on a national level. So let's just borrow at an EU level, kind of like a cop-out or workaround, so that we can basically continue to borrow to not keep this, or at least to slow the spiral down, right? Do you understand what I mean? I'm just thinking like how, if we start borrowing together, and let's be honest, the only reason we're going to get good rates is because of some rich countries in Europe who carry the Eurobond, right? Who will carry the Eurobond, exactly. So that's my point. Like, how will it help France and Italy and Greece also, who still has a lot of debt, to bring down these levels if we get Eurobonds?
Well, I mean, I've watched a lot. Well, we've made some videos on this quite a few times, but there's a lot of things that Germany needs to do to reorient its economy, right? We were just talking about reorienting the German economy. And that's one of the main things that we need to do by investing money into the tech sector, for example, a European tech sector. Tech giants like Apple, Google, Meta, they've basically been...
I get it. Sorry to interrupt you. I get it, Paul. But the problem is, right now, France has 117% debt or something like that, right? So
Yeah.
117% of their GDP is debt, and they need to repay that debt every year. So they are currently spending more than they're taking in. So that means more debt every year. That's what's happening. Now we get Eurobonds, right? So, we got new debt. So what are you saying? You're saying that the new debt that we're creating on a European level will service French budget gaps?
No,
No.
absolutely not. Absolutely not. It does several things at once, and it's important to discuss them in a bit of detail because it's quite a complicated topic. The first thing it does is it creates euro liquidity. If I want to buy euros and I'm an American, then I can only buy French bonds or German bonds or Italian bonds. Of course, there's the foreign exchange. I could just buy euros. But if I want to invest in the European economy, I need to buy their bonds.
Right.
And these markets are not as liquid. The French economy is tiny compared to America's, right? And so is the German economy, and so is the Italian one, especially when it comes to the bond market. So when we say, oh, the interest rate would be lower because France or Germany would be carrying the interest rate lower, that's not exactly true. If things are highly liquid, let's say Google stock, right? Tomorrow, I can go out and buy Google stock, right? I can buy Google stock and I can resell Google stock. There's lots of it being bought and sold every single day. But if I want to buy EU Made Simple stock, right? I'm going to have to go to Lambertus. I'm going to have to say, okay, maybe I want to buy it at 10 euros. And let's say in a few years later, I'm going to have to go back to Lambertus and try to negotiate down a price. It's not very liquid. Not everyone is buying and selling EU Made Simple stock. So obviously the price is going to be a little bit higher and it's a bit more risky to take on since I'm not sure if I can buy or sell it.
I get it. It's more liquid if more countries are behind it, but I still do not understand. That has advantages on it by itself, but what I do not understand is how will Eurobonds then help France fix their problem with their budget that's not big enough to pay off their spending? You know what I mean? Like there's a gap. France has a deficit. How will Eurobonds help fix that deficit without funneling money straight into France for paying for their social programs?
Yeah, so we should not funnel money to France. That's a terrible idea. But
are you saying that? Are you saying that this money will create growth and that growth will allow? Okay.
Exactly. We should be investing in projects which cannot be invested in on a national level. When we talk about the TEN-T network, a massive project. When we talk about creating a European tech industry that rivals the United States, or an AI industry that can rival the United States or China, or maybe selling things that's like, for example, the NVIDIA chips that we cannot build because we just don't have the innovation and investment ready for small startups and companies. That's not possible on a national level. We can only do it on a European level. And those returns can then be used to pay off, firstly, the European bonds, but to grow the European economies nationally, notably the French one, but not just the French one, the German one too, which is in need of reform now. And use that to then grow the economy, and then France will naturally pay off its debt if it can invest in its own infrastructure and its own returns.
Okay, so to summarize, again, because this is not my area of expertise, what you're saying is if we as a European Union get together and we say, yo, we need we need 2 trillion euros, which is a lot of money, of course, but that's something like that could happen. And we're going to use that money for industrial policy. And by industrial policy, I mean we're going to invest in some strategic sectors, let's say AI, just an example, maybe chips, maybe some other areas, maybe renewable energy, whatever. And we're going to focus the money there. And because of that investment that we're giving these sectors, Europe will see more growth because, of course, if a chip factory is based in Spain and gets lots of money in there, lots of jobs, etc., Spain will grow. Same with Germany, same with France. So all that money will create all of this growth throughout all of the European countries. And then all of a sudden, because we're growing by 2-3%, let's say, that'd be great for Germany and France. Then all of a sudden we get so much more tax revenue within the different countries that with that tax revenue we can start paying off our social programs without creating more debt.
Social program, I would still think we need to cut some of those.
Yeah, of course. But in theory, right? Yeah,
absolutely. I mean, that's exactly what we should be doing. And because I think on a national level, since 2008, we stagnated. Part of the reason we weren't able to go back to what we were before is because our economies are just too small. They're not integrated. We don't have a large enough market to properly sell goods and services in a way that Americans can. And so America has come in and has basically monopolized the whole European market. And so now we're surprised we can't grow. Of course, we can't compete with the Americans. They've got a much higher market with much more liquidity, much more money. And we can fix that with, again, joint spending and trying to get these companies, these European companies, to rival the American ones and to have a large enough market through the Capital Markets Union and unifying laws and tax rules to finally create an environment where we can have growth in Europe, which I don't think is possible at the moment.
Okay, so I think, okay, so your solution would be Eurobonds, borrowing on a European scale, maybe, dare I say it, loosen some of our competition laws so that we can actually have European giants.
Absolutely.
Because at the moment, what I've read and what I'm looking into, Europe is quite content with stopping mergers of companies here in Europe because they don't want to create monopolies. But instead, of course, we've got monopolies across the pond in the US that just devastate our companies anyway. So, so maybe, getting a little bit more, how do you say, like, easygoing there and allowing that to happen, and then investing lots and lots of money into proper European unicorns, decacorns, etc.
This is critical. It should not go toward, exactly that. And it should not go towards social spending.
Yeah.
But social spending has become a sink. It's not become, and I think we need social spending. It's fantastic that we have free healthcare, that we have a high standard of living in Europe, but we cannot take Eurobonds, that low rates, which doesn't just come from Germany and Austria. That's not necessarily true, but that comes from high liquidity in the euro area. And the prospect of lots of investment into high yield projects, high interest yielding projects. We cannot squander that with social spending. That would not be a good idea. But what we can do is use that Eurobonds to invest in that spending, and then that could finally alleviate other European countries and perhaps alleviate the social burden in those countries. And it would be a good way to avoid this double whammy of, do we cut social spending and essentially cut GDP, since most of the French economy and German economy is just social spending at this point, or do we increase social spending and further squashing the private markets and essentially cutting growth? That's kind of the idea there.
But Paul, the issue I see, though, I see your point, right? It allows for growth. But my problem here is, and I've seen this in Germany, is that if you go borrowing and you have all of this money all of a sudden, let's say these trillions of euros on a European level, what incentive is there still for politicians to reform their social programs at home, reform their systems to save cost? Let me give you an example. Germany borrowed 500 billion euros about a year ago, or they're borrowing it now. They're borrowing it for what they said infrastructure. And they're now using part of that to plug holes in the budget, right? So even though they promise it's for infrastructure, oh no, we're not going to use it to pretty much pay for social programs. They pretty much are doing that now. Do you know what I mean? So, and that's my issue. When you start borrowing, all the incentive for reform goes. And don't you think that would happen in France too?
I think it's a good point, but I think we should separate these two problems. Because on one hand, you're absolutely right. I mean, you're absolutely right. It's just going to incentivize them maybe to spend, or these countries to spend more. But that's a different problem than investing to try and create a higher return, right? What I'm talking about is creating a higher return, creating more competitive markets. And whilst that money could then be squandered by national governments, that's a separate conversation for each national government to have. I'm very sure that the Polish government would then take these Eurobonds and have this massive TNT network, AI startup innovation, maybe not squander it by creating lots of massive social programs and boom its economy even further. So what I would argue there is that just comes down to the national conversation, and then it becomes complicated. Do we want Europe to start regulating on social programs, on healthcare?
No,
probably
not.
No.
No.
Exactly.
No.
So that's kind of the problem we have here, and that's why I'm trying to really separate this debate. Eurobonds is good for European liquidity, eventually becoming a reserve currency far in the future, and creating these investment opportunities that we just don't have now on a national level. But it's definitely not going to fix the social program problems that we have, in Germany, in France, etc.
Yeah, I think it's look. I think Eurobonds definitely has its benefits, and we should definitely go there. I just wonder what step comes first, right? Is it Eurobonds and then we move to a more federal structure here in the European Union, or is it first a more federal structure and then we go to Eurobonds? I assume it's probably the first one. We first move to more shared, unified borrowing, and then we move more to a federal structure, because that's really important to me. Is that I would love a future European Union where some things are exclusively managed by the European Union. foreign policy. People know that. I would love to have a European army at some point, where we can save so many costs. Imagine all the national countries not having to duplicate all their structures, and we just do it on a European level. It makes so much sense, right? And moving a lot of these things in the federal level, but some things like social policy, we need to split it from the European Union, because we do not want to get into a conversation where all of a sudden these big investments you're talking about are being funneled into national social systems. I think that should, in my opinion, I know some of the chat will disagree, we need social policy at the national, the regional level, and not on the EU level, because that's going to, I don't know, make it a whole lot worse, if you ask me.
No,
Yes.
I absolutely agree. And I think a lot of these things that you're talking about, it's chicken and the egg, but I believe joint spending creates joint budgets. Joint budgets creates joint plans. Joint plans creates a unified army, unified federal structure. And we've already issued Eurobonds, right? Next Gen EU, some of the recovery for the SAFE program, those are Eurobonds. But they're not liquid
the SAFE program, I don't think. The SAFE program is national borrowing, but then from the I can't remember. How does that work again? I mean, I know. So next generation EU, 100% your EU borrowing. And then another one, the 90 billion euros going to Ukraine, 100% EU borrowing. But the way I understood SAFE is that the EU is the guarantor of the national borrowing, I thought. But I might be mistaken. I thought there was a different model for that.
From what I understand, I mean, I don't want to get into this.
Yeah, let's not get into let's not into technicalities.
For sure. I mean, it's been done before. Yeah. What I'm talking about when I say Eurobonds is not this whole new invention that's never been done. What I'm saying is, if you go just to the last slide, what I'm really talking about with Eurobonds is creating it regularly, making sure it's on the open markets. Exactly. On the open markets regularly in the Euro area countries, making sure it's available. And this doesn't need to be, people say, oh, we're going to replace national borrowing with Eurobonds. Not at all. It can start with a very small amount of money, a few billion a year. And this can be the start of something bigger. But we shouldn't start be doing 10 trillion a year of bonds. That's not what we should be doing.
Damn, Paul, you should really start a finance channel, man.
Actually, for those who are interested, I've got a big Substack post about Eurobonds that's coming soon. It's just in the description, so feel free to subscribe to see that when it arrives.
Yeah. Should we go to the chat for a little bit, Paul, to ask some final questions before we close this very technical finance stream? Yeah, so first here, Stalshia says, Paul is like James Bond, but Eurobond. Yes, you definitely are the Eurobond, Paul. I really want to know. I mean, I think there's a counter somewhere here of how often you've talked about Eurobonds, but you seem to be, I mean, I get your point. It could really help Europe with a lot of its issues. Let's have a look at this.
David said 17 at 6:15 British time, 6 minutes ago.
What? Say it again.
Loan says
17. Yeah,
17 Eurobond count.
Yeah, yeah. Do tag us if you have any questions that we can then answer. Okay, so maybe here we have a question from one of our members on YouTube. Thank you so much, Lisa Walter 5974. But who decides in which country are these bond-supported companies are built? It's a good question, actually. So we talked about, imagine we have this big, massive amount of money to invest. How are we going to decide which countries get that money and what we're going to build where, right? I mean, that's probably a massive, long procurement process, right? I mean, Paul, how would you go on to doing that?
This is one of the. This is a very good question, and this is why issuing Eurobonds would basically necessitate greater cooperation. The most basic way that this could be done is just to make it part of the MFF, right, or the what's it called, MMF, the 5-year fund for the European Union, the budget essentially. And what you could do there is say, okay, TNT, we need 10 million euros over 5 years. Let's just make that into a Eurobond. And then that could be the project gets 10 million and 10 billion, and that's just the way it's done. That's obviously not what it should be in the long term. In the long term, it should be a yearly budget that's decided by a parliament and a government that's in power. And then through that parliament, you'd have some directives and decisions that are made. That's the ideal. But of course, step by step, and the first step would be to make it part of that multi-year long budget.
Interesting. Then we have another point here. Camera Densau, as a German, I don't want to pay for the French. And this is exactly, Paul, the mentality here in Germany. I mean, already Friedrich Merz has ruled out joint borrowing because I think a lot of Germans are worried about this. And to agree, I understand it, because Germany has this Schwarze Null concept, like we don't make any debt, or at least make very little debt. And they've really spent controllably, at least until now. And then you have France, a neighbor who hasn't. And I mean, what do you see behind the statement? Aren't you worried about that too? Or as a French person, don't you understand that worry and
Look,
that frustration? Yeah.
I totally understand. But I think what politicians have framed with Eurobonds is totally the wrong idea. Eurobonds is not about, and I've talked a lot about the French problem because that's the most pressing and alarming problem we have. Germany will have to pay if France, well, I say Germany, Europe will have to pay if France collapses, which is the unfortunate reality of how it works. So either it collapses or it doesn't, but either way, there's going to be someone paying. It's not a threat, but it's just the reality of what will happen. But in terms of Eurobonds themselves, they're not to be used. This will escape the whole idea of Germany paying for France if it collapses, for example. What Eurobonds allows to happen is to invest in projects that Germany and France alone cannot invest in. That's the main idea here. And it's not Germany paying for France. It's Germany, France, and the EU, etc., paying towards projects that yield an investments and pay for themselves. That's the idea there.
It's a shame. I mean, I see your point. I mean, you have Friedrich Merz, right? The German chancellor, who is an ex-BlackRock executive. So surely this whole Eurobonds concept is not new to him, and he probably should understand or probably does understand how helpful this could be to move Germany and the rest of Europe out of economic issues that they're having at the moment. But he's really unwilling to do so, right? I mean, any hypotheses, Paul, why you think he's so against it? Is it just for public image, or do you think he genuinely believes it?
Public image, and also because the way it's been structured in the past with the Next Gen EU fund is, I don't think it's the best way to do it. I think Next Gen EU had its own set of problems. I think what we need is a more regular, collateralized and area of the central bank, European Central Bank, which then creates a plan for these funds and how they're made and how they're issued. This is going to get way too technical, so I'm not going to get into the yield curve and how it should be structured. But indeed, the way it's structured now doesn't work. And I think Merz is doing it mostly for public opinion. But if you presented him with a good plan, I think he would be down. I think he would love to do it.
Yeah, maybe. But he's so unpopular right now. He probably is worried what the German electorate will think of it if he does that. He already broke his promise once of borrowing money. And if he does it again, then it might escalate a bit too far. We have a super chat from Clota3241. Thank you so much for all the super chats today. He said the Netherlands will veto Eurobonds to avoid shared debt risks, protect fiscal discipline, and resist EU power centralization that reduces national control. Yeah, Clota3241, I think you're right. I mean, even in the new prime minister in the Netherlands, Rob Jetten, my God, I almost forgot my own prime minister, and his coalition partners have said, I think, that they do not want shared debt. I think his party, D66, is open for it, but the VVD definitely is not. So you're right. And I think a lot of northern countries, which someone else also said in the chat, are against Eurobonds. Exactly, for this reason, right? Fiscal discipline, I think, is a big one. And I think it's Paul, I just think it's hard to sell, man. I think it's just a very hard sell. Look how complex the conversation at least for me it was, maybe not for our listeners, but for me, it's quite complex to grasp some of this. So it's very hard to sell.
No, you're right. This is a hard sell, but I think it's really important to shift this from the rich countries paying for the responsible countries paying for the irresponsible countries. That is not the idea that I'm proposing. What I think we should change that to is Europe investing in projects together for a return together. Right. That's really the mindset shift that we need. I don't think it's fair to say that you'd just be compensating for France. It's could be true if it's done badly, but if it's done in a well-mannered, structured way, this could be a really big benefit for everyone and not put some of these these responsible countries at risk. So I understand the sentiments, but I don't believe, and it's not what I'm proposing, and that's not what we should be proposing for sure.